Tonight, we're going to be talking about deep tech, or at least how to get funding in for deep tech startups. What does that mean? Well, Spencer's going to explain all that, but I'm thinking it's something like super duper technical. But anyways, pleasure meeting you all. You guys, I'm pretty sure quite a few of you guys probably already know me. I'm Kay, also known as the enterprise guy, a little cheesy, but I focus on enterprise software investing at the early pre-seed angel level, right? So just a simple angel investor over here. But my buddies over here at TSVC, working with them tonight, we're going to be talking about, again, deep tech. So I'd love to introduce everyone here. Tonight, actually, it's a little bit more special. I get to sit back a little bit because Spencer's going to be doing most of the heavy work. So let me introduce you first to Spencer. And maybe, Spencer, you could maybe talk a little bit about yourself, and we'll talk about Dr. Chu or Zhang and Charles.
Sure. I've been with TSVC now for about 4 years. And before that, I've been here in Silicon Valley since, 1988, except for a year that I spent in Japan. I spent about 12 years at Juniper Networks running product management and strategy and corporate development and an engineering group and so forth, and started 2 companies, both of which were sold, and worked for probably half a dozen startups in that time. And I've done angel investing and now doing early stage venture. And here representing TSVC, which for those of you who don't know us, we are an 11-year-old seed stage venture fund. And you see behind me and my colleagues here some of the companies that we've seeded. Zoom all the way back to 2011 at 11 cents a share. Ginkgo Bioworks was an IPO in September of last year. Carta and OpenTrons and lots of other good companies, many in deep tech and also some in other areas. And I apologize for my voice. I'm actually, I've managed to avoid COVID until this week. I finally got it. So I'm quarantined here in the guest room in my house, and happy to join you all today.
I gotta say, your voice is still, radio voice qualified. Still sounding good, man.
Well, it doesn't sound. Anybody who knows me is going to be like, has he started smoking or what?
Well, Spencer, we all hope you get well, and also thank you so much for being here tonight while having COVID. Dr. Xu or Zhang, would you like to introduce yourself?
Okay, since you called me Dr. Xu, and so I got two PhD, and one in electrical engineering and another one in material science. So after graduation, so I joined Applied Materials, and the largest semiconductor equipment manufacturer. Spent about 13 years over there, and started with an engineer, and gradually moved to the senior management, and was corporate vice president, and running 3 product division, and multi-billion-dollar revenue on an annual basis, and very high profit. But afterwards, I feel a little bit bored, and stay with Fortune 500, and actually Applied Materials is Fortune 100, and the company. So I just decided to say, okay, let's try something new. So in 2007, I just start high efficiency solar panel company, and with my partner, Dr. Fu. So we rent a very small garage in Sunnyvale, near to Central Expressway. Its size is less than 1,000 square feet, and that's how we get started. And the 2 people, and they try to build a lab, and try to demonstrate first a very small size of high efficiency solar cell, and in order to raise our first seed round. So the company ran pretty well, and so in 2014, the company was acquired by SolarCity. It's a Tesla company, and that was a good exit and the investor, and they are pretty happy with that. After that, I worked for Tesla for 2 years until 2017. So I started a new company called eBots. Basically is intelligent robot, and particularly for robotic AI-powered robotic eye-hand coordination, and for manufacturing or any desktop or tabletop assembly task. And at the same time, I work on investment. And last year, I joined TSVC as a venture partner. And the primary focus is Yeah, one robotics, and two clean tech, or now we call the climate tech. That's is two key focus area. Thank you.
Awesome. Awesome. Dr. Shu, it's a real pleasure having you here tonight and looking forward to hearing your insights. Moving over to Charles, would you like to introduce yourself?
Sure. I'm within TSVC for more than 10 years, starting limited partner first, then venture partner, then general partner since 2017 and Fund 4. So right now it's TSVC Fund 5. And I was in the NetScreen founding team back to 1996. So finally, the NetScreen went public and got acquired by Juniper. And besides the TSVC investment, my personal investment, including a Giga device, Spectrum, and several other personal investments. So that's my background. Very glad to see everybody here to talk about deep tech.
Awesome. Hey, looking forward to having you here. And a little bit of a side note or a fun joke over here. I believe during the happy hour, I was talking to Charles, and I told him, like, you know, you look super familiar. Like, you must be like a celebrity or something. But you know, the funny part is, like, that night I came home, went onto the TSVC website, and realized, like, oh, he's a general partner. So yes, now I recall where we met. So guys, gentlemen, real pleasure having you all here tonight. I guess to move on to the next part, and you know, a little bit of admin work here. People in the crowd, please, you know, ask as many questions as possible. Feel as super comfortable, anything, like just ask anything you like tonight. I want you guys to have a lot of fun, and I'm going to do the best I can towards the end to answer all these questions. But tonight, Spencer's going to be doing a lot of the heavy work. He's going to be doing the moderating between Charles and Dr. Shu. So Spencer, if you'd like to take it away, you know, I'd love to be, you know, the attendance over here.
Sure, and you're welcome to jump in with any answers that
Sure.
That come to your mind as well. So
Hey,
I'm going to start with, I know we're on, so we're on deep tech today, and you know, as part of our ongoing series where we're covering different topics in the funding universe. So what is deep tech, right? I mean, what's included, what's not included? Charles,
Okay.
you want to start?
Yeah, definitely. I volunteer to answer this one. It's a little bit difficult to define the deep tech. Every people have a different opinion on that. From my point of view, it's easy for me to see what is not in the deep tech area. So my view is, for example, the Airbnb or Uber, I will consider that not deep tech, or SaaS, software company. Normally I will not consider that a deep tech. So looks like it probably the deep tech is they have a very high tech threshold. Equivalent, say, is probably is a long circle journey for the deep tech company. Normally more than 5 years, even up to 10 years for the deep tech company we're going to invest. So anyone longer than 10 years may not be, it's probably the deep tech, the startup, but our sweet spot for that.
Yeah, so there's deep tech, and then I mean there's too deep tech, right? So if it's more than 10 years to get to market, it's more research and too deep for this sort of investing. But something with a 5 to 10 year horizon could be the ideal deep tech.
Yeah, that's probably it.
So how about a trick question? Zoom, deep tech or not deep tech?
From my point of view, I will say still not is not deep tech to me.
And here's why it's a trick question, because I know a little bit about the Zoom story. It was not my investment. I think it was not your investment, but our partners, Chun and Eugene did this investment. What I learned about the Zoom founding story is that they spent quite a lot of time with at least 15 engineers building a new codec. Because they made the observation that everybody thought that Skype and WebEx and so forth, that they were, they already had cornered the market. And what Eric Yuan, I believe, understood was that the codecs that existed, even Google Meet, by the way, licensed an off-the-shelf codec technology, but Eric didn't do the usual thing with a minimum viable product, launch something in a few months with a few people. He spent an enormous amount of engineering energy building a new codec, which to me potentially qualifies as deep tech. Now, we can disagree about that, but I think there's a deep tech story that people don't know about Zoom, which is why I said it was a trick question. Anyway.
Yeah. I partially agree.
Yeah, Dr. Xu, what's robotics deep tech or not deep tech, or does it depend?
Robotics, I would say, if it's application development, I would not treat it as a deep tech. But if it's a scientific discovery based, and I would say that's a deep tech. For example, artificial general intelligence development, that's definitely a deep tech. It's related to mathematics and science discovery. But if we talk about find a new application and just use the OpenCV module to tie together something, and let's say AGV, and can move around in the warehouse or maybe in the restaurant, that's I would not call deep tech. So it's really depend on and the level and the effort we need put into it for at the discovery stage. That I would say the other like a biotech, that's this type of field. It's most time we'll call deep tech because it's a majority investment is discovery. And then I think in the robot or material science field, then another part we call deep tech would be in engineering innovation. It's a very, very good engineering concept, and that's create a huge barrier for competitor to enter. So that's also deep tech. Also take time to come up with this critical and innovative engineering design concept as well.
Got it. So very high technical barriers. That makes good sense.
Yeah.
Now, you've both been involved in starting companies in deep tech and investing in deep tech for more than 10 years, more than 20 years, I think. So you've had time to see the entire cycle pay off. And some companies that have a 5 to 10 year horizon, they succeed. Some companies after 5 to 10 years, they don't succeed. So what are some examples of successes? And then what are some things that maybe you say, gee, that didn't work, and so let's not do that again? What would be, what are patterns or anti-patterns on both sides?
Yeah, I want to hear first. Successful case, well, that's very easy. That's my real experience back to 20 years ago, the NetScreen. It's a first hardware-based encryption decryption plans. So we are targeting firewall plus checkpoint at that time. So the major competitor or major market share occupier, it's a checkpoint there. So at that time, we think.
So you had right. So you had companies who were writing software, and you embedded that into silicon for the first time. Very high technical barrier, right? Correct.
Yeah, we're using the firmware try to replace that software stuff. Yes. So anyway, I will say the market is big enough at that time. So everybody asking 100 megabytes per second, which is line speed security product. So that's definitely the great market potential there. So fail case, well, I cannot say the name of the company, but it's definitely is a deep tech company. They're using a homemade material, which is not in nature world. So they build that material in chamber, and within that material, this company built a analog phase array radar, which is suitable for, which is 77 gigahertz suitable radar for autonomous driving. It's a very great technology, and team is a scientist coming from a research lab in the big company. So anyway, I personally love the technology very much. So I pushed hard, try to convince everybody to invest in this company. But turns out it's not failed. It's not failed so far, but since it's not unicorn, it's not meet our criteria in last 7-8 years already. So I consider that's kind of not successful, but it's our real case. So I learned a lot from this case, from this
So
company.
do you think that was the problem too hard and they couldn't solve it, or they solved it, but then the market wasn't there?
Yeah, they solved it. They solved it. They got the product out already, but the market, the market, basically moving market, moving target changed the marketing position. So they still have product, they have a sales, but just not big enough.
And that's an interesting point, because when you talk about, technologies that have a 5 to 10 year horizon, you have to be forecasting what the market wants in 5 to 10 years. If you come out with something and say, look, this is a hard problem, I'm going to solve it, but then 5 years later, the market wants something different, then you're too late, right? Or maybe it's just, when you did solar, Dr. Chu, I guess one question I've always had about really innovative technologies is there can be something that comes from a completely different direction. So you're pursuing one path, but then you might be surprised by something that comes from an entirely different place. So how did you know the technology? Well, first of all, what technology were you pursuing? And then how did you know that was, that there wouldn't be something else, if it took you several years to get to market, that something else wouldn't come along completely from the side?
Yeah, I think when we really look at the deep tech, first thing I would first look at is use the first principle to look at that in this market, for example, in the solar energy market. And we just, first one is use quantum mechanics and look at the device and what type of energy conversion efficiency from photon, which is from the sun, and generate how much electron, which is electricity. So that's certain of the fundamental limitation from quantum mechanics or thermodynamics, which limited the ultimate solar cell or solar panel conversion efficiency. Then the second one is, and this is try to solve this whole planet energy problem. We have to really look at what the material base is required to do that. So then we really, at that time, we noticed that there's many different kind of material system to making solar cell. And then we look at that, some of the material, it could be great in terms of conversion efficiency, but there's a rare available on this planet. And if we need a larger scale deployment, it will not be a viable solution. But the scientific research in the graduate school, and that's great. So then we decided, okay, so the silicon still will be the primary approach, because the silicon is the second abundance in the Earth, and the first one is oxygen. So that means, if we choose silicon material, that would be good. And then third one is you really look at the manufacturability. And these things can be manufactured at a really high scale, very large scale, you know, like a solar panel. And it's with good yield. And production yield is ultimately determining the cost. So we just evaluate all those three sector, you know, and the ultimate physics limitation and the materials availability and as the manufacturability, which can we utilize existing manufacturing equipment. You know, if we need to develop a new manufacturing equipment, that will be a disaster. It will take a very, very long journey. And then we just, then we just realize that, okay, maybe that should be the approach. And maybe if in case, if people have a different approach, it's going to be very, very difficult to challenge the approach.
So you're protected by the laws of physics. I like it. That's a good competitive advantage, is to have the laws of physics on your side. When we have these events, you know, oftentimes a lot of our attendees are entrepreneurs, right? And because our topic is deep tech, we may have some deep tech entrepreneurs in the audience today. I don't know if anybody's throwing questions out that are related, but let's jump to how to get a startup funded. When you're doing something in deep tech, you know, there's obviously a lot of investors in the world. Most investors don't want to touch deep tech, or when they do look at it, they don't know what to do with it. So you've been funded, Dr. Xu, in a couple of deep tech startups. How do you go about getting funded? What are some tips and advice you give people who are trying to get their deep tech startup funded?
I think quite a few so-called deep tech field is market is already pretty clear. And if we really look at clean energy or climate tech, and everybody know that, at least I think the majority of people in California think that the climate change is a big problem. So the demand are already there. And then we talk about robotics, and its demand is pretty strong, especially in the manufacturing field. Labor shortage, labor cost, labor availability. So the demand is already there. So that's one thing, is we first approach the investor, and then investor pretty understand. And because the headline news, all of those demand is already there. So now next one is, and usually have a three risk, right? The market risk, technology risk, and then operation risk. So now second one is, now we need to really talk about the technology risk. So the technology risk is, first we need to convince the investor uses the most plain language, like what Einstein talked about it. Use the most plain language to communicate with the investor. That's in principle, we don't have a problem. And then in terms of scalability, and the problem, because we just use the analogy, those type of equipment we have, and it's already used for different industry. We put this together and try to convince the investor. And the third one is just to do a small sample, like we're doing. It's just to make a few small sample, build a, rent a garage, use simplest equipment, like we call Scotch tape experiment, to verify the concept is right. Then we can start to talk to investor. Hey, this is something and actually is working. And the only risk is operation risk. We eliminate technology risk, eliminate the market risk, and now the risk has become 33% instead of 100% risk. And then a lot of time the investor will say, okay, so now at the 33% of risk level, maybe we can bet on it, give a try to make some investment.
And that's an important point, because I think a general rule for venture investing is you want to have only risk on one of those three dimensions, right? I mean, you either want a proven technology with proven team in an unknown market, or, and if you can de-risk all three, then perhaps it's too expensive. But you're right, if you want to limit the risk as an investor to one of those three dimensions. Charles, any thoughts there?
Yeah,
when you look at companies, right, what's the reason for you to say no? And then how did somebody fix it? And you said, yeah, I want to invest in that.
Well, I definitely want to see the entrepreneur founder. They are 100% or 120%, 150% time on this project, on their venture. So when that's going, that's the first question they ask. So where are you now? Where are you yesterday? So basically, yeah, we are all quit from Intel, from Siemens, whatever. So we quit.
Yeah, that's a really interesting point, because I know we within TSVC a number of deals where it's a professor who has an interesting technology, and we end up passing if the professor is the lead founder and doesn't want to leave the university or take a leave of absence, right? Now, there's cases where the professor may nominate one of his or her students, and the student is the lead founder. The student, could be a fantastic entrepreneur, and the professor is an advisory role. That's a fantastic situation. Also, Ginkgo Bioworks had 5 founders, I think, right? And in Ginkgo Bioworks' case, the professor joined not at the very beginning. He joined a little bit later. But yeah, I know we've had a lot of difficulty, and we've decided not to invest in companies where the lead founder is not full-time, right?
Correct. That's probably our golden rule.
Yeah. And I think there's a couple of things around that. One is, of course, it takes so much energy to start a company. And I think people mistake the science for the company, right? And you say, I've got this great science, but having science is not the same as building a company. It's 5%, it's 10%. The activity of building a company is all the rest. But the other is, if the professor doesn't think this is really the best thing in the world and is going to make an enormous impact on the universe, then that's also a signal, right? If the professor says, oh, I want to keep my, now I understand if I was a professor, I would want to keep my day job because it's a pretty nice job. But at the same time, as investors, we're always seeing people who have left their day job. And so if you have 10 investments coming at you, if you have 10 investments coming at you all at the same time, and 9 of them have left their job and 1 has not, then the ones who are full-time, they're going to be more attractive for investors.
Yeah, so definitely this is the primary role for the founder. The second sign, the positive sign, is that the founders willing to put their own resources, even the cash, into the company to make a prototype work. So that's another sign. Because the next Green founders, everybody put probably 20K into that company for 9 months to build up FPGA-based prototype, PCBA ready to demonstrate basically prove the concept. So there's another level of the positive sign.
So commitment from the founders, right?
Yeah.
Commitment, financial commitment, time commitment, all in, right?
Yeah, all in, yeah. So that's really demonstrated you as basically you and yourself, your team highly believe yourself for this project.
So can you think of a case where, I'm sure there's lots of cases where the team was all in, but still you said, no, I don't think so, not good enough. What would be a reason for that?
Well, the team must be complementary each other. It's if 3 of them or 2 of them have a very strong in the same field, that's not good sign for the company.
I think that can be true, although I want to give the example of Juniper Networks. I was not, our partner Eugene was among the first, I think, 10 or 20 people. I came in later, a couple of years after that. But one of the things that Juniper did very successfully, they identified that routing software, specifically BGP protocol, was the most important technology. And they said there's the top 10 engineers in the world, we want to have all 10 of them. And over a period of 5 or 6 years, they got, I think, 7 or 8 of the top 10, not all at the same time. But it was really interesting because at that time, I was also in the industry, but at another company, I was selling to all of Juniper's competitors. And all of Juniper's competitors had either 0 or 1 BGP expert, and Juniper had 3 or 4 or 5 BGP experts. And by the way, they fought with each other. They had all kinds of disagreements. Apparently it was very difficult, but they were the only one company that was successful in that space. But at the same time, they also had a great salesperson. They also had a great hardware person, right? So they had the complementary technologies and the complementary capabilities. But in that case, they had more than one of one of the areas.
That's a little bit different. It's a little bit late stage. I mean,
True.
First stage, yeah, only 3 people. These 3 people must cover 3 different areas.
That's
probably,
true. And the first 3 people
were, probably one software lead. They hire top 10
right. One
people.
Software, one hardware, one semiconductor. Exactly.
Yeah, that's great.
Yeah, very good.
Yeah.
That's a good point. It's a good point. So you talked a little bit about, both of you, what kinds of things somebody should say when they're pitching, what kinds of factors we look for. Sorry. What kind of investors should you look for if, at the early stage and at the later stage, what type of investors are going to be the most successful for a deep tech startup at different stages?
I just have one comment. Basically, during the pitch, I like the investor who can ask the right questions, so I can understand they really appreciate my work. They really understand how deep my tech is. So that's that definitely I like that kind of investor.
Got it. And Dr. Xu is smiling, so I think he has some. Maybe he's going to tell us who's not the right investor. I don't know.
Well, I think the key point, I agree with Charles. We need to find that some people can have a resonance with your idea. So if it's a deep tech, and there gotta be really some people familiar with, at least familiar with this field, or people already actually is working in this field for a long time and really have an in-depth knowledge in this field. If not, at the early stage, you have a challenge to educate the investor. So basically, you and the investor are going to learn this topic all together, and until people feel comfortable. Okay, so that's one. Or another one is investor need to find another expert to evaluate the project. So this makes the whole project, the fundraiser cycle will be pretty long.
Got it.
Yeah.
I know that I don't have a lot of familiarity here, but I know that both of you have some familiarity with the landscape in China, and I've heard that deep tech in China has been very hot lately. That valuations are high, the number of companies starting in deep tech in China is high. You have the advantage of seeing the US market, the China market. I know we also get pitches from Israel and from other places. Number one, is it really as hot as what I'm hearing in China for deep tech in domestic companies? And number two, if so, why do you think the difference in one region versus another? Again, you're smiling.
Yeah, just simple. I think it's probably right. It's a pretty hot there because China is a big government society. So anything it's a government promotion, or basically, government promotion played a big role, very big role. So semiconductor is under the pressure, or under the government, very strong pressure, try to speed up or try to growing that kind of sector. So public dollars and private money went to that sector a lot. So semiconductor area is pretty hot. And the ESG, for example, battery, the new material, battery, everything, it's a lot of investment into that area. So that's triggered a lot of the similar companies coming up.
Yeah, the deep tech in China, I would not say majority actually is not deep tech. Okay, so it's just caused by the trade war between US and China. Let's first look at deep tech, semiconductor, which is the field I've been working for a long time. Semiconductor is not deep tech. What the people in China try to do is catch up. It's not really try to develop a new field. Let's say if we don't have a trade barrier, and let's say, and we don't have export control. And let's say, and if China is Canada, and I don't think the people will continue work on develop a semiconductor, develop on the aircraft engine, or develop on the biotech. People in China will be probably more close, like in US, more focused on the cloud computing, the artificial intelligence, and advanced robotics, those type of field, instead of work on something called the semiconductor, which is are 20 or 40 years behind, especially like semiconductor equipment. And people, I even right now recently get a couple of calls from the investor VC firm in China. Hey, Zen, can you take a look at this business plan or this plan? But I would say, so most of what I saw is just a catch-up project. I don't think this is a deep tech.
That's interesting. So that may answer my next question already, which is, if you were going to, and I guess you made this choice yourself as well, but if you were starting a company now, would you start it here or in China? I mean, here meaning the US. I know our audience is everywhere, but we're in the US right now. So would you start it in the US or in China?
Well, I would say, I prefer here. Actually, I'm doing it here and advanced robotic technology. And in Silicon Valley, and you get the most brilliant talent. And, it's completely freedom of thinking. And now you really get into just based on the science or mathematics, concept, and really aim at the leading edge. And if you go back to China to do startup, and sometimes I just use a pretty harsh word, is basically, and in China, you are not basically most are investors over there, and they think the best innovation is too risky, and actually, bring the existing technology and start the similar one in China. That's actually seems the most popular for the investor in China.
Well, and what I've observed in my time, which is about more than 30 years here in Silicon Valley, is that what's great about you think about, there's this concept of a destination restaurant, right? It's a restaurant that is not in the middle of downtown. People don't walk by and walk in. They have to go specially to go there, right? And Silicon Valley is a destination for people who are strong in technology. There are other places, obviously, in the country. There are other places in the world that also have talent. But so many of the best people in the world make their choice to come to Silicon Valley. It's been a very successful model for quite some time. Interesting. So I'm not 100% sure, Kay, how much time do we have? Should I hand it back to you? Should we keep going? What's the program?
Hey, we could go all night if you like. I'm just kidding. For the most part, I'm guessing you got your series of questions to ask the two gentlemen here. But if not, we could transition it back to the crowd and do Q&A. I was thinking, 8 o'clock, 8:15. That's the target where we would end this event tonight. What do you guys think?
Yeah, if we have questions from the audience, that's always going to be an exciting place to go. So
Sure.
What have we got?
Sure. Okay, so let's dive into it. So I hope everyone here is having a good time tonight, and I'd love to see some of the questions that you have. And I know we have some questions earlier, so let me roll into it, and I'll ask around. So let's see. The first question that we had, let me see, which one should I ask? Going down is, will the war in Ukraine lead to capital loss for startups? What is your take?
I guess I'll start with an early stage perspective, because I don't try to forecast the public markets. I don't try even to forecast late stage, right? I stick to what I know, or what I think I know, which is early stage. And for early stage, not a lot of impact. Now, we do have one company that's fairly early. They're A round stage. They have their engineering in Ukraine. Happily, their engineers are all safe. Happily, their engineers are still, able to check in code. So for the moment, things are working out. But at the same time, the company, this is an offshore engineering group. They can reform a different offshore engineering group if they need to. Late stage, whole different story, but not my world. So for early stage, as much as it's a difficult situation and a tragic situation for the world, I don't think it really affects early stage companies.
Dr. Xu or Charles, if you have any comments on? So if you don't have any other comments, I actually have some comments on that, because I kind of have to look at both public and private markets to kind of decipher like where I think, who's going to deploy capital next, right? So if you ask me, does Ukraine, the invasion in Ukraine lead to, capital loss in startups? I would say yes, in a way. It would trickle down from public markets to late stage, but early stage, where we kind of focus, it's a little bit different, but I do think it affects it in some ways. So let's say, Russia invades Ukraine, which basically, again, it's a statement across the world, and the whole world goes into sanctioning Russia. And then from there, we go from a globalization economy, or globalized economy, to now deglobalization. We disintegrate. So when we disintegrate, all the supply chains get all jumbled up, and it creates market volatility. And you never know, governments are manipulating the monetary policy, fiscal policy, rising interest rates, putting pressure on other economies around the world just to play their geopolitical battles. I think eventually that volatility trickles down, right? It trickles down because it's going to hit the high growth segments. So stocks like Netflix or any other enterprise software companies like Snowflake, they get hit. And if you know Snowflake or some of these top tier enterprise software companies, you also know like some of the prime VC firms in Sand Hill Road are super invested into that. So I think eventually those guys who are rolling like $1 billion plus fund, they're eventually going to cut back. And when they cut back, it's going to trickle down. Now, again, this is me explaining the macro and then getting into forecasting the public markets, which ties to the macro, which kicks back into the private markets. But initially in the private markets, I would say it's the late stage. The late stage private markets is kind of like momentum money, right? Funds like Iconic Capital or whoever, where Mark Zuckerberg keeps his money, they throw a lot of capital. And so I need to decipher the macro and think about the privates and who's got the biggest wallets in the private markets, because they're, again, as a small angel investor, I'm looking at, all right, where do I think, Iconic Capital is going to deploy $100 to $200 million next, or even Tiger Global or whoever. So for me, I think it matters because I'm trying to derive insights from where these bigger players are deploying capital. So I definitely look at the macro. I definitely look at the public markets. I definitely look at the late stage public funds, especially the multi-billion-dollar ones, right? We're talking about 1 billion to 100 billion plus, just so that I could front run them at the early seed stage. Sorry, Spencer, you had a comment on that?
Yeah. Well, I think it's an interesting point, and what I mean, if we zoom out to where you're describing, I do think that there's been this strategy. So we wrote about this in our last investor letter. There's been a strategy started by SoftBank Vision Fund, and now copied by many others, to use capital as a weapon and say we're going to overcapitalize companies, and that's how we're going to win their market. And I think that strategy is, personally, I think it's over. I don't think it ever was successful except in very special markets. So Uber was the right place to do it, right? Because in Uber, to buy into a city costs $20 to $100 million, right? You have to give bonuses to attract new drivers. You want to sign up 1,000 cities. Each city costs $40 million, right? That's a $40 billion problem, right?
Right.
but most companies can't absorb that much capital productively.
Yeah.
And you take something like WeWork as an example, where you can put as much money as you want into it. You can inflate its valuation as much as you want. The fundamentals aren't there.
Yeah.
So I think for companies that lack the fundamentals, that are
100%.
competing just based on capital,
Yep.
yeah, that capital is going away. It should never have been there in the first place, if you ask me. But you know, the fundamentals will win, and that's why they say, you know, the market in the short term is a voting machine, and the long term is a weighing machine.
Yep.
So if you wait long enough, the true value comes out. But in the short term, speculation will drive volatility, right?
Yeah. So like the way I kind of view it in the pre-seed seed stage is that I'm really looking for that crew, that team, the group of founders who are like, of course, very deep tech, right? Or like, let's say like a data intensive startup or whichever. But I'm really looking at their grit and ability to stomach through a volatile market condition that I expect is going to be lasting for several quarters to even like several years. So the grit of the team is very, very important, but also, you know, the deep tech to me is also very important because if you're building fundamental tech, I think you're moving humanity forward. Now, you know, valuations might not be great for me if the volatility environment is really bad because I'm looking at the 0 to 1 billion valuation, but I'm looking at Altimeter, Iconic, Tiger Global when it goes from 10 billion to 100 billion, right? Because those guys are the momentum players. They got the deep pockets. They throw $100 million checks. So I look at them to see if they're going to cut back, but I'm always going to be deploying checks into what I think is deep tech. So to give you sort of my definition of deep tech, right? I kind of think about, you know, deep tech to me, the way I kind of think about it is it's always a moving position. It's like it's the natural state is always changing. Like deep tech is always going to be evolving to the next thing. In some ways, something like, you know, I think the question that you asked earlier is like, is Zoom deep tech, right? I think in some ways Zoom has been very consumerized, or it has the greatest consensus globally, and so it makes me always think back about the greatest device that's, you know, in all of our pockets, right? Is when you know, right now this pen right here, maybe between us 7 people on stage, 6 people, 7 people, you know, how much would you pay for this pen? You probably pay like $1, $2. But the moment I connect this pen and put 1 million eyes on it, consensus will alter the value of this pen. If we connect 1 million eyes to this pen, it could be worth $1 million. Okay, maybe not 1 million, maybe $100,000, right? You put a story to it, so there, you know, there's that factor, that emotional factor, irrational factor that you could apply to stocks, right? Stocks like Tesla, you know, behind Elon Musk behind Tesla, really, you know, Elon Musk is the premium driver of that valuation. It doesn't make sense, but he wields so much consensus or traction or distribution that everybody will just keep up the stock price. So when you go out there and you vet, like, you know, deep tech or the founder's ability to distribute and build up influence and audience, I think all those components are key, right? If you got both factors, deep tech and a strong influencer that knows how to go out there and use modern technologies and distribute, get in front of like everyone in the world, that's some powerful stuff. Because at the end of the day, to me, you know, there's people who are inventing deep tech, and then I see a lot of startups where all they're doing is they're stitching deep tech, which is very fascinating. When you stitch deep tech, and that's basically, you know, you guys know Amazon AWS, they got right now one of the deep tech models or startup concepts out there is the data lakehouse. I don't know if anyone's heard of that, but Amazon AWS says they have a data lakehouse, and all they did was just stitch a bunch of their products together. So you got to be careful out there. You know, looking for deep tech, be careful for a person that's just kind of, I mean, I guess that's true intelligence. You're stitching a bunch of deep tech together. But anyways, that's take on, you know, Ukraine, globalization, deglobalization, how it's going to further cause commodity prices to rise because of, you know, we're not working together anymore. Eventually it trickles down. At least that's the framework I have in my mind. Going on to the next question. Will it be a difficult time to launch a supply chain based startup considering the supply chain issues going worldwide? So I think we kind of touched base on that one with the whole Ukraine, but Spencer, if you'd like to answer that one, or anyone else.
Well, it completely depends on what the company's doing. I mean, if it's a great time if you have a solution to some of today's urgent problems. You know, if you say, well, gee, I can optimize things that help people avoid the issues. I don't know how you would do that, but the entrepreneurs that are online here, perhaps they do. You know? I do think one of the things, and you talked about volatility, you know, one of the things we've seen, I mean, there was this whole movement for just-in-time manufacturing, right? That was started in Japan. It was propelled by McKinsey and other management consultants. And what it's resulted in is these brittle supply chains where, you know, if you're anticipating that you can get anything by FedEx tomorrow, then you hold no inventory. And we're going to see a world where there's more inventory, more work in progress held at different steps in the manufacturing cycle, because of volatility and because of the, you know, you can't count on everything, you know, oh, I need something from Taiwan tomorrow, but maybe there's no containers available, right? So as a result, I think we're going to see a buildup of inventory work in progress. Perhaps there's a supply chain startup that can help us do that more intelligently and say, okay, because what McKinsey and others have said over the last 2 decades is, you know, all inventory is bad. Let's go to zero inventory, zero work in progress, because there's an embedded assumption that we can always get what we need. I think the next generation of supply chain technology is going to be robustness against disruption, and say, okay, how little can I hold, but not zero, in order to be robust against disruption.
Interesting. Zhang or Charles, do you guys have any comments?
Well, I think supply chain, you know, it's really depend on which type of supply chain you want to build. For the physical supply chain, and maybe have some disruption, and you know, the factory and the COVID, the war. But I would say, you know, if we do supply chain outsource, it's like in the software field, for example, you know, data annotation for artificial intelligence. So this type of supply chain should not have any impact as long as you can find the right resources. You can continue or develop a supply chain, and also the internet bandwidth get broader and broader in all those business. The transaction should be able to do that.
Mm-hmm. You know, it's interesting that we talk about like AI and AI being in every software out there, right? And AI at the end of the day, it's just like someone's a founder's ability to create software that really is able to leverage a lot of data. So AI at the end of the day, you know, I just want to kind of meet consensus here. If you guys agree on it, AI at the end of the day is just a more data intensive application. Is that a true or false statement? Is that a fair way to say it? 2 PhDs, so you gotta correct me.
Well, I think it really depends on, you know, AI right now. I would say specialty AI is supervised learning. So this is extremely, people always talk about data is oil. You know, it's basically you need a tremendous of data, and the data is king, and the data have a great advantage. So that's one of the field of the AI. And then on the other side, you have unsupervised learning, reinforced learning, yeah, which is much less depend on data because the system start to learn by itself.
Yeah.
So that's one thing. And then we talk about further deep in the more advanced AI or general artificial general intelligence. Yeah. So that part is become less data driven. But yeah, at the current stage, and the AI, which is an emerging market for application, yeah, yes, it's a heavily data driven.
Yeah, see, so, you know, to tie back to the supply chain question, right? So of course, like anything, if we're talking about physical supply chain, then yes, like, you know, war on Ukraine, market volatility, all that stuff's it's gonna make it really hard for physical supply chain, right? Shortage of semiconductors, and that bleeds into everything. Now, but when we're talking about AI, we're talking about a little bit of a different supply chain. It's a digital supply chain, right? The movement of data and the way we process data once it goes through that processor or whichever. And so, you know, when I analyze Wall Street and the consensus of Wall Street, or what I think Wall Street knows, I think there's one thing that's lacking that not a lot of people on this planet kind of realize. And what I think it is, Wall Street, they have these valuations on companies, right? And especially in the space that I play, enterprise software, at one point it traded at a high multiple. A really good enterprise software company, Snowflake, at one point was trading at 115 price to sales, which basically means every $1 million they bring in, you create 115 million in valuation. So crazy, insane multiple. But that made me think about something that it was a statement. Again, whatever I see in the public markets, high multiple valuation, it makes a statement to the rest of the world, or at least for me as an investor. The insight that I developed from that was I realized that Wall Street might put valuations on fancy new technologies and stuff. But if you actually take a step back and kind of just forget about whatever financial knowledge or Wall Street taught us, and just think about the objective of humanity, right? We keep on pushing technology forward. Like in a period of when I think about 5,000 years of history, empires came and left, right? They started and they failed. But the one thing that stuck around was technology, and it kept moving forward. So now that we're getting into this new phase with Moore's law, where technology kind of just advances quicker than ever before, when I think about it, I think about data. And that's like one, I guess, asset or whatever, data as an asset class, whichever. That's like one thing that's exploding every second. Like the last hour that we had this Zoom, we created unstructured video data. And this is happening across the world. There's so much of this data. And so it's getting to a point where technology is just overriding Wall Street valuations, to a point where I question if humanity is going to be able to put a value on something that's just exploding and it's never going to stop, which is data, right? Structured data, unstructured data, semi-structured data. So when we talk about deep tech, and the way I'm kind of looking at the markets is I'm going out there looking for startups. And again, I'm being resilient to market volatility. I'm ignoring market volatility, but I'm aware about the late stage players who are going to dump money like the $100 million checks. But I'm looking at the deep tech, and I'm being mindful of the trajectory of the human race and thinking about the explosion of data, right? So sorry, I kind of went on, but it's just me talking about the physical supply chains and then making people aware of the digital supply chains, which involves the movement of data and the explosion of data.
Well, and for anybody who hasn't seen this, I would recommend, so Ray Kurzweil, 15 years ago, wrote this book, The Singularity is Near. And he described some of the phenomena you're talking about. And what he observed is that technology advances, but also it keeps advancing faster. So the curve of technology is positive. The first derivative is also positive. And as a result, he said, okay, the time it took for, let's say, the iron to become popular around the world was 1,000 years. And then the time it took for the next tech, for the plow, was 500 years. And the time it took for the cell phone was 10 years. And the time it took for Instagram was 2 years, right? He says that keeps getting shorter and shorter. And the singularity was not his invention. It was invented somewhat before that. But the singularity is the idea that technology will start advancing so rapidly that the next sort of intelligent machines will be able to design themselves better than we can. And so if a machine is 80% as good as a human, then, it's doing pretty well. But when it's 120% as good as a human, you just let it run by itself and it will go to infinity, right? And that's why they call it the singularity, right? So this idea, which he wrote about in 2005, 2006, it's amazing that he said it back at that time. It's not specifically data, but he talks about 3 key technologies, the computing technology, nanotechnology, and biotechnology. So genetics together with nano, and I think nano hasn't quite kept up with the other 2, but still important. But there we go. His argument from 2006 is that somewhere in around the 2030s, and I think we may be actually running a little bit ahead of that, somewhere in the 2030s, we're going to see a world where machines are able to replicate themselves faster than humans can. And that will be not just a quantitative change, but a qualitative change in how things work.
And that's why I go back to the statement that I made earlier, right? Like, why is it that, humanity has allowed Snowflake to trade at the highest multiple of 115 times? Like, there's something about it. Like, if anything, the world from consensus was signaling something. And And what I came to conclusion is that no matter how advanced the technology is, you yourself cannot move forward in the world without bringing the rest of the world with you. So you have to benefit the world in order to move forward. So again, it goes back to, if you want to make the valuation, you have to enable the world, because valuations are social, but technology is more objective, right? So to quote you earlier, Spencer, I thought this was pretty interesting. I made this slide. Well, I took a picture and I kind of edited the slide, and this was part of my Venture Capital 3.0 deck that I presented to a family office. And basically what it showed is like what you're talking about, the whole singularity, that the time to market, it was less and less. It just keeps getting less and less and less.
Yep.
So let me explain to you guys with some annotation. On the y-axis right here, it's basically revenue, right? And the time to the revenue is at the bottom, as you can see right here. There's an interesting company called Pinduoduo. I don't know if people know, but everyone knows ByteDance, which is TikTok. And that company reached 20 billion in revenue in a period of 8 years, faster than the FANGs, faster than, you know, these companies right here, which are the connected enterprises. So there's something different about these enterprises. And what I came to conclusion was that these were intelligent enterprises. Pinduoduo is like social e-commerce 2.0, like the way they're, you know, shopping 2.0, you gamify it and all that stuff. And then ByteDance, TikTok, right? TikTok, on the surface, it looks very simple, right? It looks like simple tech. It doesn't look deep at all. But if you actually dive into the technology of TikTok, it's a powerful recommendation engine. And it's one of the deepest techs on the planet. And it's so addicting that it hooks consumers to infinitely scroll through it. And I think if more people understood these intelligent applications, they could go a lot further in life. But I think this chart does a really good job of just explaining like how crazy fast these valuations from a revenue perspective, right? It took Pinduoduo only 5 years to hit 5 billion in revenue. And that's quicker than all these enterprises that we knew, Google, Facebook, Amazon, Twitter, right? So there's something about this next generation or era of startups that I think a lot of people should pay attention to. And I think these, you know, quantitative charts like this does a pretty good job of just kind of revealing the secrets of the world, right? So I just thought I'd share that among our discussion tonight. So I'm going to close that out. I hope you guys, you know, take a snapshot or whatever, but I'm going to close it out. Stop my share. So I know we have, let's see, maybe we'll last for another 3 minutes or whichever. Let me see what other questions. People in the crowd, do you have any questions? I hope you're having a good time. I'm just going to read over here. I guess the last question, let's make this the last question because I want to be respectful of everyone's time. Is crypto or Web3 deep tech to you guys? Anyone could start.
I'll echo the same answer that Jung gave about robotics. I think applications of a library, you know, if you make an application, that it could be an interesting application, it could be valuable. I don't think it's deep tech, right? When you take a core technology. Now, the core technology itself could be deep tech. A lot of it's kind of a solved problem. I think, you know, moving from proof of work to proof of stake, you know, there's some interesting math there, right? There's some interesting science there. Most of the companies we see in that world are not deep. Now that said, in the Web3 world, we did see one recently, which is a very interesting deep tech company, which is they've invented essentially a no-code functional programming system for kids. So the technology behind it to make functional programming accessible to children actually requires an enormous amount of behind the scenes technical know-how. And that I think classifies as Web3 because it's applied to metaverse and all kinds of other interesting stuff. It's not crypto. You know, the other thing is that just the Web3 and crypto universe is so broad that the answer is always going to be it depends, right? You can have a deep tech concept within that world, and you can also have lots of applications which are interesting but not deep, right?
Zhang, did you have a comment, or Charles, on Web3 and crypto?
Go ahead, Charles.
Well, I think definitely there's no clear line between deep tech or non-deep tech. So if we really want to make a line here, we just have our criteria there. Say it's a high entry barrier, the long cycle, 5 to 10 years come up. And so if we really want that definition, I think Web3 crypto, I think any startup company within this kind of a technology try to make a startup grow faster. So it may take 2 or 3 years to get a really rich company there. So to my knowledge, in TSVC, we have a clear old definition, because definitely crypto Web3 is definitely the GP classification is the guy who responsible for deep tech is not responsible for the Web3 crypto. So that's our internal assignment.
Dr. Xu, did you have any comments on crypto or Web3?
Well, I tend to agree with Spencer. You know, it would be, you know, it's really deep Web3 as well as the crypto. Actually, it's a very, very broad field. Actually, you can really, you know, divide it into many fields. And the certain of the field, I would say it would be a deep tech and particular. And we deal with the algorithm development, the data compression technology for the metaverse, those field. And this involve a lot of scientific research and discovery, and that's, I would say, it's a deep tech. But that's a lot of people work on the application layer. So that part is really depend on and how you can capture the market and quickly move forward for market penetration.
To share my insights on, you know, Web3 crypto, is it deep tech? The way I when I dived into the whole space, right? You got so many things, everything from layer 1 to layer 4, and you got everything from like crypto enterprise infrastructure to like NFT, you know, layer 4 applications, NFTs, DeFi, and all that other stuff. So it's interesting. You know, the way I kind of, at this point, it kind of forced me to think about, like, is this really innovation or is it not? And what I came to the conclusion is almost like in corporations, you have a profit center and a cost center. So is this product cost optimization, or is this product pushing more profits, right? So when I thought about crypto, I thought about vertical innovation and horizontal innovation. And let me explain to you why. Smart contracts, to me, I kind of, in my mind, I classify it as horizontal innovation, where I get it. We're under a sovereign, and the sovereign kind of centralized, like, you got to play on our system. They are the biggest entity and the monopoly entity. So every other corporation has to respond under them. And so I get the whole decentralization trend, and smart contracts are basically an evolution of a legal system, a paper legal system, into a algorithmatized digital legal system or smart contract system. But, you know, to me, it's like, is that really innovation, like vertical innovation or horizontal innovation? So I classify that as like a cost center type of thing, right? Cost maintenance type of thing. So it's smart contracts are a horizontal innovation. But now let me tell you where I found vertical innovation within that horizontal innovation. So let's take for a moment diving into the DeFi world, right? DeFi is decentralized finance. There's traditional finance like Charles Schwab. Then there's CeFi, centralized finance, like Coinbase, right? And then there's DeFi, which is purely decentralized. Now, that's a crypto category. It's a layer 4 application, it's DeFi. When I was actually diving into DeFi, I found vertical innovation that only exists in that horizontal innovation. And what it was flash loans or flash lending and flash central bank, basically. So the thing about that is, I noticed that these sophisticated DeFi traders were using flash loans. These were DeFi hedge funds, and they were using flash loans. And these flash loans do not exist in the real world. The only thing that we have in the real world is like a central bank, right? So it's kind of interesting that I discovered what I think is true innovation that can only exist in that horizontal innovation. So I don't know if that makes sense, but a flash loan is basically, you want to make a trade and you want to lever up, right? And so, but you want to get a loan to make that even more profitable. So you get this quick 100 million in a flash, and right when the transaction's done, you clear it out. So that to me was like, wow, like that's what central banks do, but they can only do it in a slow manner, like low frequency in the real world. So now I discovered like this crypto world and DeFi, there's some true vertical innovation there. So I don't know if that makes sense, but that's kind of like, my attempts to try to answer like, is there deep tech in crypto? That's how I categorize it and what I think market participants would put a valuation on it. Anyways, Spencer, you had a comment?
Is that innovation good or bad? Sounds like it's going to drive more volatility, right?
So ironically, some would argue it would drive more volatility, but some would say we're correcting the system at scale, and someone willing to go and transact a flash loan is willing to take on that risk. And if that trade doesn't happen, the loan just reverts back because it's all algorithms.
Well, I guess we'll see, but history shows that whenever somebody invents a new way to create leverage, it creates a new crash, right?
Yeah.
That's happened for hundreds of years. But
yeah, leverage is a double-edged sword, so that's something that we all can't forget, right? Even as VCs. Well, guys, it's 8:20. I don't want to push it too long. I want to be respectful of all the people that we have tonight. So I'm pretty sure I got through most of the questions, but there were some very beefy, long paragraph questions that I can't get to. I do apologize. But I just want to say, thank you to all the panelists tonight. Thank you, Spencer. Thank you, Dr. Xu / Zhang, and thank you, Charles, who I thought was a celebrity, but you're a GP over at TSVC. But thank you guys very much tonight, and especially the audience. Thank you guys. Like without the audience, we wouldn't have anyone to talk to. I guess we'll just talk to each other. So, so thank you all, and I hope you all have a great night, and hope to catch you in next month's session.